Welcome to the Retirement Cafe podcast, episode 52. All you need to know about equity release.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Cafe podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and accredited later life advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Cafe podcast, which is brought to you by the Retirement Planning Specialists, MFP Wealth Management. Now, as you know, the current generation of retirees has benefited greatly from quite dramatic increases in house prices over the years. Yeah, and this is great news for retirees in general, but for some people, they find that the majority of their wealth is tied up in their property. Now, for those struggling to afford the retirement that they want or desire, or even the retirement they need when it comes to paying for care or other later life costs, equity release can be an appealing option. This week, I'm really pleased to be joined by Martin Lyons, who is the Business Development Director with Just, one of the leading providers of retirement solutions in the UK. So Martin is here to answer all our questions about equity release. Welcome to the podcast, Martin.
Well, thank you, Justin. It's very good to be with you today.
Well, Martin, for the benefit of listeners, who are Just and who's Martin Lyons?
Oh, okay. Well, Just is a provider of products and services, primarily looking at how we can help people in the sort of the later life and retirement arenas. I mean, our background really is in terms of underwritten annuities and things like that, but clearly that knowledge can be applied to lots of different things. Equity release, as we're talking about today, long-term care, underwritten annuities, that sort of thing, to really try and get people a better deal in retirement. And so from my perspective, I've been primarily working with product providers over just a little bit over 30 years now. So a lot of experience in retirement and that sort of thing, working with advisors and groups of financial intermediaries around the country, talking the talk and helping people with their planning for later life, that sort of thing.
Wow. Okay. 30 years. That's a lot of experience. We're very lucky to have you here today. Could you explain, for the benefit of the listeners, I mean, I've got a little bit of a clue. I did some exams in equity release many years ago. Not something that I commonly talk about nowadays, but for the people who don't know or not familiar with what equity release is, could you explain what it is?
Yeah, I think it's becoming a more significant part of the retirement arena, really. But what we're talking about here is essentially a way that we can enable people to use the value in their home to help with their retirement planning, whether that be an aspiration they have in retirement to, for a certain lifestyle, or they want to help out other people in their family, or there's some other issues that they want to sort out, maybe going into retirement. But I think if we think that, of people's biggest asset, or often their biggest asset financially, is the home, it's a way of releasing money from that asset in order to help with financial planning in retirement to meet their goals and objectives, really, over that period of time. So, it's one of those things that can really give a boost to people's finances in retirement, should they wish to look at that particular avenue,
Right. And I mean, is it in essence taking a mortgage out when you've finished work?
Yeah, I suppose essentially, most equity release, when we talk about equity release, we're talking about lifetime mortgages. So there are some similarities between a lifetime mortgage and a normal residential mortgage. I suppose the big difference is that you're not looking at having to make regular repayments necessarily.
Right.
So I guess if you think about the typical individual who has retired, they're not using, if you like, human capital to generate their income from work. And therefore, this is a way of getting access to a mortgage solution without having to physically make the repayments, during that period. Having said that, a lot of lifetime mortgages now have gone down the route of allowing some repayments to be made. Right. So things have changed in this arena, over the last few years. because some individuals may choose that they actually want to make some repayments, so they can have control over how much mortgage they've got outstanding. So they don't necessarily have to continuously roll up that loan, and increase that loan if they don't want to. So, as this sort of arrangement is evolving, there are more options for people. But yeah, it's essentially, in most cases, it's a case of taking out a mortgage,
right,
on your main residential property. Yeah.
Okay. And I mean, could you give me an example of how it works? I mean, i.e., so I don't know. Let's say we've got a 70-year-old couple living in a property worth, I don't know, £300,000-400,000 with no current mortgage on it. I mean, what could they gain from coming to someone like yourselves and getting a lifetime mortgage?
Yeah, I mean, a lot of lifetime mortgage lenders will look at age and maybe they'll make some decisions based on age and if you like the potential term of that mortgage, if I can put it that way, to work out what sort of loan to value somebody might be able to get from that. I think the important thing though is also looking at, well, what do they actually need? Right. So whilst you might have a maximum loan to value that person might person might be eligible for, the starting point is always what they need, because after all, there's no point in taking on a bigger loan, if you like, than is necessary. So to have a look at that, work out the amount of capital that they need, and then essentially what you've got is a situation where, after underwriting and valuations on the property and those sorts of things, normal sort of process when you're with regards to lending, the money is then released to that individual. The charge is then on the property, as you'd have find it with a normal residential mortgage. But as I say, the difference is that they don't necessarily have to make any repayments. Certainly they wouldn't make any capital repayments. If they do, then there's other things to consider, early redemption charges and so forth. But typically they'll just have that lump sum, or they may have geared it towards an income. The interest on that will just be added, if you like, to the loan, on an ongoing basis. They can decide to make some interest payments should they wish, or some other payments, subject normally to a maximum around about 10% a year, something like that, if they choose that particular route. No negative equity guarantee. So if that loan is rolled up to the degree that actually, it's taking up a larger percentage of the property value, by having that sort of safeguarded environment through the Equity Release Council, which kind of safeguards equity release plans for those that have signed up to it, it means that they're not going to, or their family isn't going to face problems later on with regard to that. So there's some safeguards in place, but essentially it means that they can get access to the funds that they may well need in retirement for all sorts of different reasons, really.
So what kind of mortgage can they get to the value of their property, or is that just dependent on their age, or what are the criteria?
Yeah, it tends to depend on their age, really. Each lender will have a different sort of set of criteria. Maybe there'll be a 50% loan to value, something like that. So you're not taking the whole of the equity in the property, but again, it's going to depend on their age and their circumstance. One of the things that we do as a provider of lifetime mortgages also look at their health and lifestyle as well, because with our particular background and our knowledge around those sorts of issues, when we look at retirement planning, we can apply that to lifetime mortgages as well, to essentially take a more scientific view of how long the loan is likely to be outstanding, because after all, loans are typically repaid should the individual pass away, or they move into something like a care home environment, and so we can take a view on on sort of longevity and those sorts of things. So underwriting can come into it. That will have an impact on the loan to value available as well. But I think what we find these days is that each case is really judged on a number of different criteria. Age, property value, the interest rate might be different depending on the loan to value as well. You might get differences in how much is available depending on whether the client is looking at a regular income, or a lump sum, or indeed the advance to date, but keeping a reserve in place for later. So I think where people are looking at it is really a case of looking at it, bespoking this to their own individual needs. I think gone are the days where you had, here's our equity release plan, here's the loan to value, here's the interest rate, and we're getting more to an environment where these plans are being more and more tailored to the individual to see what that individual personally could achieve, in terms of the LTV and the interest rate available.
Right. And the LTV being the loan to value. So
that's right. Yes.
The type of value of the property and how much the loan that you're borrowing. So that's quite key. So obviously, probably I would have thought that the older you are, the less life expectancy that you have, of course. That kind of follows. We all know as we get older, we'll live slightly less longer.
Sure.
And then, of course, the value of the property and what the lender, I suppose, is looking at is at what point they get their money back.
Yeah, there's a risk. There's an element of risk there in terms of how long is the loan going to be outstanding. That will obviously impact on the LTV, the loan to value they're prepared to offer, the interest rate, and so forth. So, that's why you find typically.
So these
businesses.
These products. I mean, when I started in the financial services world in the late 80s and the early 90s. The products available now have shifted quite dramatically, haven't they? I mean, and I think they got a bit of bad press in those days. Why do you think that was, and how's the world shifted, I suppose, to improve these products?
Yeah, I think back in the day you had a lot of plans there which were kind of home reversion type plans or shared equity type arrangements whereby the lender effectively owned part of the property or percentage of the property, so that if your loan to value, if you were taking, let's say, 25% of the property was the amount of the loan, there were plans where actually that lender then retained 25% of the property, whatever that property grew to, and things like this. Were people clear in terms of what they'd actually got? Did they understand the ramifications of that? Did they understand how the loan would build over a lifetime? I'm not sure that in every circumstance people were fully aware of around that, and I guess we're in a different disclosure regime these days as well. And so I think there has been some bad press if we go back a number of years on equity release, and I guess some people still remember those times, and that's impacted on people's attitude towards this type of arrangement. But in recent years, you've had SHIP and the Equity Release Council bringing in these safeguards that people are signing up to. So whilst you've got regulation through the FCA, you've also got safeguards to make sure that people, that firms are acting responsibly, having things like a no negative equity guarantee, these sorts of things, making sure that people are aware of the facts around how charges might be borne within the arrangement, that sort of thing. And I also think that there's an attitudinal difference now whereby people are starting to look more holistically about their retirement plan. So we're not now talking necessarily about something that people might necessarily do as a last resort type of situation because they've run out of capital or whatever it might be. Or they're helping out the next generation. There's only certain ways of doing it. I think it's more a case of we've got a world opened up in terms of things like pension freedoms, for example, and more options for people to say, well, actually, I'm going to use a different asset. I'm going to retain that pension as a family trust, for example. I'm going to use that. Perhaps that's going to be what I'm going to use last in some circumstances, and I'm going to look at can I draw from my property first? And we've seen massive house price growth, as you mentioned earlier, and so we're talking about significant assets for individuals that, they might want to draw upon.
Sure.
Yeah. Sure. So I think the market has changed. Attitudes have changed. People are looking at property as an asset rather than just a home, which clearly it is. And there are some emotional aspects there as well. But people more and more are looking fairly pragmatically and objectively around, how can I use this property in retirement? Perhaps more so than they've done in the past.
Yeah, I think I'd agree. We know that some figures recently released that many more people are looking at this, and many more people are borrowing on their property. Now, I do understand that you can get a lifetime mortgage that just provides a monthly income rather than a lump sum. Now that sounds a pretty attractive offer. I don't know whether you offer one of those products, but could you talk a little bit about that?
Yeah, I guess it works in a similar way in terms of assessing what the client is eligible for in terms of how much the lender is prepared to offer them based on the property value and things that we've talked about already. But rather than having that in one lump sum, it's really just a case of turning that into an income. So often you'll find that over the plan as a whole, the individual might actually be able to take more than if they had the lump sum up front. So that might be, a reason for looking at this. And also, of course, if they haven't taken all of that money up front, they're actually working out how much they need on a monthly basis. Then obviously interest won't apply until those monies are actually drawn, which again can be beneficial in terms of the roll up of the loan and things like this. So over the longer term, that could represent really good value for a lot of people. You also might get the situation where, and certainly something that we offer is where the individual could be looking at a reserve. So not necessarily taking all of the amount they're eligible for now, even if it was a lump sum basis, but maybe keeping some aside or knowing that there's an extra pot, if you like, there should they wish to draw on it. And again, there's no interest payable until such time as those monies are actually withdrawn from the equity. So there are some advantages if somebody's really mapped it out and worked out through maybe cash flow modeling and these sorts of things that are being used these days, and really worked out, well, how do I want to use a property, rather than having a lump sum and then converting it into an income. Maybe for a lot of people, it's just taking it as an income in the first place, and then the benefits that might have for them in terms of cost and interest and things like that.
Sure. I can imagine, that's quite an advantage, obviously, just paying the interest or having the interest rolling up exactly at the point that you need the money. I also understand that there's another kind of newish option, which is retirement interest only mortgage. And what's the difference between that and equity release?
Yeah, I mean, one of the things that I think we're seeing more of are people that are coming to the end of an interest-only mortgage, getting to retirement age, and then thinking about, well, what do they do next? Particularly if you've got a situation where there is no repayment vehicle. And so this is why perhaps, people are starting to talk around retirement interest-only mortgages. I think one of the key differences is things like the income that you need to repay in a retirement interest-only mortgage is you've got the same criteria as you had with any other residential mortgage, in the sense that you would have to prove affordability and things like that. Now, that might be a good option for people if the interest rate stacks up and actually they've got an income coming through. The lender might take into account retirement income. They might differentiate what's guaranteed and what isn't and things like this, or they might have some other income that, depending on the lender, they might want to look at. The lifetime mortgage that we're talking about, the individual wouldn't necessarily have to prove income, because obviously there's no income, there's no repayments to be made from the individual necessarily, unless they opt for an interest service type scenario. But actually, even if they opt for interest serviced, there's a way there of repaying interest, but not having to evidence income and things like that. So, and obviously the charge is on the property in the same way, and the loan is redeemed in a circumstance where the client passes away or moves into long-term care. So it's all around, proof of income, that sort of thing. Obviously, with a retirement interest-only mortgage, so closer to the normal residential style mortgage, if the individual can't make those repayments, then clearly there are going to be ramifications there. Whereas you wouldn't have that with a lifetime mortgage where the interest is rolling up, or they're choosing to repay it. So, you've got to weigh all these things up, of course, and you've got things like a no negative equity guarantee on the lifetime mortgage as well. But yeah, the retirement interest only mortgage closer to a normal residential mortgage. It is a normal residential mortgage, effectively.
Right.
Proof of income, normal criteria. If somebody's retired, they may not have that income that they can prove, and therefore a lifetime mortgage might be a sensible option for some individuals.
Sure. Now, I mean. You've obviously given us a lot of information here, Martin, and I can imagine if someone's sitting here listening, thinking, "Oh, I want to consider some equity release," what do they do? Where do they go? How do they find out? How do they find out as much as you know?
I think from our perspective, because we are a provider of these sorts of things, most of our work is through intermediaries.
Right.
So we would always say, sit down with a financial advisor on this, get some expert advice from somebody who can look at this in the realm of everything else. So, taking an holistic view that says, okay, what have I got in terms of property asset? What about pensions? What about other investments? And seeking the advice of somebody that's not just dealing in the area that we deal with here at Just, but looking at the overall picture, that can really drill down to each individual client circumstance. So often we use, unbiased.co.uk, or if the client's already got an existing advisor that can help them, that's probably the way to go, really. So it's seeking that expert help, and I think with a lifetime mortgage, with an equity release, it's a case of just thinking about that as an option, and not really discounting it until you've spoken to somebody who's got an expert opinion on how that might fit in with the rest of the client's financial plan.
And are there specific qualifications that someone should look for, or do they need to be a member of a professional body? What's the kind of criteria if you were recommending your aunt's or uncle or something to go and investigate this, and they lived up and way away from you, where would how would they find out the exact right person to talk to?
Yeah, the professional bodies do issue examinations. So Chartered Insurance Institute, CISI. You've also got the likes of the Society of Later Life Advisors as well, who will look at in the round about issues like long-term care, equity release. That whole later life piece is an extra standard as well. You've got the Equity Release Council, which applies the standards to firms also. So making sure that somebody's operating within the guidelines of the ERC as well. Ultimately, the regulation is through the Financial Conduct Authority, but looking at those qualifications, the ER1, the equity release qualification, or the CISI equivalent as well. But yes, there are standards that people can look for. But if you go on to unbiased.com, these type of websites, they will show you the specific specialist areas that people might hold qualifications for as well. So that's always a good one to look at, to make sure they have that equity release qualification.
Absolutely. So, I understand, listening to you now, I think the key message here is that actually this is a solution for a lot of people. It is quite complex. You need a bespoke solution, i.e. something which is designed for you and your individual circumstances and what you're trying to achieve, maybe as a single person or as a couple, and probably involve your family ideally, because if the next generation realizes what you're doing, they maybe offer good advice or even check to make sure that you're doing the right thing.
Exactly. I think it's realizing that this is an asset. It can help the individual from the next generation's point of view. It could be the right thing for mum or dad to do. I think we need to get past some of the assumptions around equity release and really look into the detail behind it, because it can be a real enabler for people to have a better retirement.
Absolutely. Well, it's been thoroughly fascinating listening to you, Martin, and I appreciate your time. I really do, and I'm sure our listeners do as well. So before we kind of round off, could you explain to the listeners how they can find out more about the work that you do and how they can get in contact with Just if necessary?
Yeah, certainly. As I say, we do most of our work through financial intermediaries, but our website is probably the best place to go to find out more about Just as a business and what we do. And there's some resources on there as well. So that's We Are Just. There's no dots in there, and then .co.uk. So wearejust.co.uk, and that will give you our contact details and everything you need to know should you wish to get in touch.
Fantastic. Thank you for your time.
Thank you.
If you'd like to find out more about equity release and the services that Just provide, check out the show notes on our website at theretirementcafe.co.uk, where you'll find some useful links. Next week, we will be launching into a series of episodes all about changing the perceptions of aging. starting with an interview with the co-author of a fascinating book called Bolder, Life Lessons from People Older and Wiser Than You, by Dominique Affijan. So why not subscribe if you've not done so already via iTunes or your preferred podcast player so you are sure to catch next week's episode. As always, please email me with your thoughts or feedback on hello@theretirementcafe.co.uk. So until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Cafe podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.